morning, everyone. It is Friday, July 23rd. Yes, it's Friday, not Saturday. It's Friday. And yes, this is a surprise live stream. When I woke up this morning, I had no idea I would be doing this. But it looks like Stephen Dow from Velocity Mortgage is feeling under the weather. And, I've had some coffee, I had some energy. I wanted to do a session at 8 a.m. So what the heck? We will do a live stream just for you. If you have questions, go ahead and leave them over there in the chat box or whatever you call that thing. I do have some topics that I will run through that I've collected throughout the week. I'm doing this from my computer, not my phone, so the video quality may be slightly lower. And I'm still fighting with AT&T to figure out why my internet is behaving so poorly right in the heart of the Silicon Valley. Craziness. But anyways, again, thank you for watching. Thank you for all the support. It is fun to see the one rental at a time story, methodology, brand, whatever you want to call it, build. When I look at the positive impact score, it is truly growing. It feels good to see more and more people do the work. It feels good to see people get deals. It feels good for people, frankly, to walk away from deals when they go from being good to bad, right? When bidding wars happen. So I enjoy what we're doing here. I enjoy staying positive. I enjoy answering questions. This channel is here for you. I'm not here trying to trick some algorithm or whatever it's called. But if you like what's going on, you can leave a thumbs up if you want. You can subscribe. You can ask others to join. That would be great. So I have a couple of topics that, if there are no questions, I will just run through. And the first one I'm gonna talk about is the median price. The median U.S. price. Where are my notes from this morning? Here they are. Is up 112 months in a row, posting 363. I just want to tell you, I think the median home price sometime next year is going to fall. And it might fall by 10 or 15%. Now, you might be asking, what the hell, Michael? You keep telling me there's no crash. Yeah, you talk slowdown. Why are you telling me the median home price could fall 10 to 15%? Folks, that is the oddities behind the word, or I think it's a statistical vocabulary, median. The median home price in the U.S. has been skewed, unbalanced, whatever you want to call it, the last 12 to 15 months. The median home price is simply, think about all the housing transactions in the U.S. lined up back to back, from lowest to highest. Okay, that's median, right? You pick the one in the middle. If there's 1,000 transactions, you pick number 500. If there's 900 transactions, you pick 450. So what the media is not telling you, and what I want you to understand, is the last 12 to 15 months, the median home price has been skewed unnaturally. For example, today on the Daily Financial News, which we just closed, I told you the median house price was up 23%. That is nuts. That is unhealthy. That is a statistical anomaly which we should appreciate and realize it's going to reverse. So, what do I mean by that? I got some numbers here. Where are they? Oh, there they are. So again, why is that? Well, the pesky word median. So did you know the last 12 to 15 months, the number of houses that are transacting or closing between 100 grand and 250 grand, which, by the way, for most of the country is kind of the average home, that price or that number of transactions has fallen almost 20%. So if there used to be 50,000 transactions between 100 and 250,000, I forgot, what did I say, 50? So now there's 40,000. There's less of them. And then if you go to the other extreme and you look at houses between 750 and $1 million, folks, they are up 131%. If we go to the even further, the houses over $1 million, They're up 149%. Folks, the median house price this year, like the one we reported today, is garbage. It's not really a true representation of average. I suspect the average home in the United States is more like 260. Median is being skewed because the lower end is not transacting at normal levels and the higher end is over transacting. Folks, if you've been watching my channel for any length of time, you know we've been talking about the K-shaped recovery. The K-shaped recovery is what it is. You can argue it's not fair, but it is creating an unbalanced real estate market. The damn Richie Rich, the top end of the K, they've been buying second homes. They've been selling one home and buying another. The bottom end of the K, first-time home buyers, all of that stuff has not been transacting as much. So this 363 median home price of up 23% will not hold next year. I believe we will see a median home price fall next year, and the media is going to lose it. The housing market will be healthy. The average home price actually might go up. Get this, the average home price could go up while the median home price falls. Think about that for a minute. That's just the oddity of math. And that is something I don't want anybody to think about. I think the fact that the median home price was up 23% year on year, which we talked about today, is unhealthy. It's not. The real estate market is very skewed to one side today. And I think that unwinds and we transact more lower end or homes between 100 and 250,000. So you got to be very careful when people talk average or median, because they're very, very different numbers. So I have more things to talk about, but I said I would answer questions. So let me go and see what's here already. Good morning, Jeffrey. Good morning, Tamika. AR, let's just say median is different than individual. I don't know what that means. Yes, it's a statistical difference. Okay, fine. First time home buyer in Bay Area ready to put 40% down. Wow, still monthly is about 50% is my take home. Hold or wait. I don't know your financial situation. I don't know. All I would tell you is, damn, the Bay Area is expensive. Man, Bay Area is expensive. A lot of stock market money here. I don't know what it would cost you to rent. I don't know how long you're going to stand here. Anybody that would give you financial advice based on that one little thing is not helping you. There's much bigger decisions to make, and it's a tough call. I totally get it. For me, the question is, how long do you want to stay in the Bay Area? Need to update 2006 to 2021 comparison. Median home price is 363. We got to watch median versus average. I actually have to go back and look at my chart. You're right. I don't know what was in there, but yeah, I don't know. Median 363. Average, I think, is like 287 or something. You got to watch when people talk, and I may have messed it up. Let's see. Remember the change of median. Yep, exactly right. Oh, you don't think inflation will affect home prices? Yeah, median. So I got it. Average is 287. So yeah, I was right. How about that? It's almost like I do this for a living. I think inflation is affecting home prices. I think it affects home builders. I think, yeah, I don't understand the comment or the question. So yeah. Tamika, I'm receiving proposal letters from investors interested in buying. Yep, Tamika, I am too. Wholesalers, direct mail, phone calls, texts, smoke signals, cards in the mail. It's kind of crazy stuff. Panay, I hope I'm saying that right. Panay just bought a house in Pittsburgh this April for $150. Congratulations. Did some small repairs and surprising at $190. Now thinking of refinancing at the end of the year. Congratulations. 2006 versus 2001, number of cash out refis are way less. I'm assuming you're referring to 2021. Absolutely. Yeah. Cash out refis are much less. One thing, folks, actually, I was going to talk about it later, but we might as well talk about it right now. Debt. We did a conversation with the three amigos, Dion, and the lumberjack yesterday, and myself. And we talked about home equity line, which I thought was a great conversation. I think that video went out at 8:00 last night. But I want to talk about debt. You can be Dave Ramsey and, all debt is evil. debt snowball, all of that, to some of these wannabe high leverage, borrow everything you can, don't leave equity in your property, blah, blah, blah types. And what I want to tell you is I'm somewhere in the middle. Maybe, if Dave Ramsey's here and these other people are here and it's like 0 to 100, I'm probably like a 55. So just over the middle. I think more people need to respect debt. In the real estate investing world, I think you need to, in the real estate investing world, I think more real estate investors would be wise to respect debt. I sense, based on yesterday's video on home equity lines, there's a rush to start using your HELOCs. And hopefully you heard me talk about that being dangerous. I think HELOCs, as I shared, HELOCs are a tool, and a tool when used correctly is very wise, but a tool used incorrectly can kill you. Think about that for a minute. I believe debt is a tool. And again, a tool respected and used correctly can do amazing things. But a tool used by someone who hasn't learned how to use it, who is overexcited, who just throws out all precautions and training, it won't end well. So I think more people need to respect debt. I don't think you should fear debt. That's the one thing with Dave Ramsey I disagree with. And this, again, isn't consumer debts and credit cards and, payday loans and all of those things. This is investment debt. I owe millions of dollars in debt, millions. And I would not be sitting here at 8:00 on a Friday morning doing one of my 3 interviews or discussions if I wasn't financially free because of that. But that's because I've respected debt. And if you watched our HELOC interview, I wasn't going to go all in. I would never put my family, my wife, my daughter at risk. So I think more people need to respect debt, but you shouldn't fear it either. I've interviewed several people on this channel that are Dave Ramsey fanatics. And all I got to tell you is good luck. You're going to be working for 40 years. It might end well, right? You may be a millionaire when you're 65, but that wasn't for me. I didn't want to hope I was still alive at 65, right? One of the scariest metrics I saw early in life was like, if you started saving every day and you're like 25, by the time you're 65, like 12% of you are dead. I mean, that just slapped me in my face. So yeah, I mean, it's certainly possible, but pretty crazy. So let's see what else we got here. All right. Just bought a house in Pittsburgh. Got that one already. Yep. Send me over a card. You've helped me with my purchase too. Jay, I need your address. DM me your address so you're not putting it on, you're not putting it in the public. But sure, send me your address. I'll send you a card. One of these bad boys. I got a whole bunch of them. I already bought them, so all it cost me is a stamp. Yeah, go ahead. Post the link, Jeffrey. Go for it. Congrats, Jay. Yeah, congrats. Okay. Again, go ahead and post your questions. I think I got them all. And again, Jeffrey, feel free to put your link in. I hit accept. I thought you were posted already, but go ahead. All right. What else do I got? What else do I have? Oh, getting started. It's Friday. If you were thinking about real estate investing and looking to get started, I got kind of a 5-step plan for you. First and foremost, my advice to you is get focused. Too many new investors are chasing butterflies. That is an April Crossley reference, or chasing bunny rabbits. That's an Anna Kelly reference. Too many of you, when you reach out to me, you're like, I want to do this, I want to do that, or I want to be in this city or that city. What you don't realize is all real estate investing, buy and hold, flipping, wholesaling, Airbnb, apartments, mobile homes, land, whatever, it all starts with buying right. And I believe, as I've said, this housing slowdown is coming, or is actually underway. It is going to be the time to find motivated sellers and buy right. It's not going to be easy. Motivated sellers don't just wave their arms and say, look at me, but they're out there. And my students are already finding them, and it's an awesome feeling. It's actually a better feeling than me getting another deal at this point. First thing is you got to focus both on what you want to do and the market you're in. You can't learn two markets at one time, at least not at the beginning. You'll get confused. In order to focus, the strongest suggestion I have for you is create a buy box and look at that buy box every day and look at nothing else. Document, document, document. Learn, get repetitive. It's 10 to 20 minutes a day. Number 3, you do need to figure out if you're bankable. Some of you all aren't bankable. Don't have the down payment, don't have the credit. You got to work on that. I don't know what else to tell you. You need to learn your market. I believe the only question you need to answer is what's an average deal. Once you know average, you can do good or great. And then number 5 is you got to do daily disciplines. You got to look 10 to 20 minutes a day. You got to grow your network one a day, whatever it is. I put all of this in painful detail in my course, How to Get Started One Rental at a Time, link below. More importantly, though, we have more and more experts adding content, which is just awesome to see. Yeah, it's just awesome to see. So I think Matt, the mortgage guy, which I'll talk to later today, already has 4 more videos for you on Mortgage 101 that should be loaded over the weekend. Crazy stuff. All right, let's go back here and send out or see what other questions you have. Hi, April. How are you? Prasanna, how are the appraisals doing in Fresno or other markets? Are they coming up to contract price nowadays? I can only speak to my experience, Prasanna, and my students' experience. I have not heard about an appraisal coming in light, at least for an investment purchase. When I talked to Omar, the real estate entrepreneur, on Tuesdays, I think it's Tuesdays, he is telling me some of his buyers' appraisals are coming in light because they overpaid. So it really depends. Investor, and if you're an investor, you're only buying good or great deals. Those typically appraise. But if you're an owner-occ and you're overpaying, it's a problem. It's a problem. Thoughts on pre-sales? Jay, I'm going to assume you're talking about, I don't know what you mean by pre-sales. Are you talking about new builds? Or are you talking about pocket listings for whatnot? I'm just curious. Awesome. Congratulations. I'm going to say Venti. If I'm mispronouncing that, I'm sorry. DM me your address and I will mail you a card. Once it's closed, though. No cheating. It's got to close. All right. Again, folks, this is for you. So if you're watching and have questions, feel free to leave it here. Oh, condos listed in advance of development. So first off, traditionally don't like condos, don't like HOAs. They have a lot of rules that make it unfun to be landlords. But if you get a good deal, yeah, I mean, I don't know. I just don't like condos. HOAs, no fun. No fun. If you're watching my daily financial news, I put out a question. It actually came from Jonathan Twomley. And again, do me a favor. If you're watching this and you're part of Jonathan Twomley's Facebook group, send him a note today telling me, hey, I'm here because of One Rental at a Time. He was wondering the other day if anybody watches our videos. So go blow up Jonathan Twomley's Facebook post so he knows that One Rental at a Time fans are out here. Anyways, he put out a post. What is scarier? What is scarier? And there's only 2 options. Don't overthink this. I put my answer in his Facebook group today, so feel free to reply, but I'll answer it here. What is scarier? Inflation so bad you don't want cash? Think about that. When I think that, I think Venezuela or what happened in South Africa one time where the money just became toilet paper or trash. So that's what I think about when he put that question. Or number 2, a crash so bad you only want cash. Think about that. So I thought about that for a while. Oh, Zimbabwe. Yeah, that's the one. Not South Africa. I'm sorry. Zimbabwe. You're right. I love it. My audience is so on it. That's just awesome. So when I thought about that question, I thought about my investment world. I thought about what I am experienced in. So what I had to answer the question was inflation so bad you don't want cash. That is what scared me. And the reason that is because I've never experienced it. I wouldn't know what to do. I would be likely as freaked out as everybody else. I certainly would enjoy my real estate, although I would have to go month to month on rentals instead of yearly leases because they would need to be reset. My debt, I have I don't know, call it 60% LTV, maybe 55% LTV. So the debt would be kind of easily paid off, which would be cool. But taxes would go up. I mean, it would, I think that is scarier to me. And it's because I haven't experienced it. I have been through a world where things fall off a cliff. Stocks, I was very up close and personal with the dot-com bubble. I was obviously a part of the Great Recession. I saw a house that I sold for 264 retrade at 75. So I've experienced those worlds, maybe not together, but I've experienced them. So a crash where cash is the only answer, I could handle. I wouldn't enjoy it, but I could handle it. I don't know. Would I enjoy it? No, I don't think I'd enjoy it. So the one that scares me more is inflation so bad, cash is worthless. That would truly be frightening. I've never been through it, so I wouldn't know how to act. So let me know what you think. Which one scares you more? Blow up Jonathan Twomley's Facebook group. That would be appreciative. Yep, Zimbabwe. Thanks, guys, for correcting me or helping me. That was very helpful. Chris, thoughts on new refi discount for FHFA? I don't think it is a discount. I think what they've done is they've dropped a 0.5% kicker. I believe it was about 9 months ago, FHFA, like lots of banks, saw stress in their lending book, their existing lending book. And they said, oh my God, foreclosure, short sales coming. That didn't happen. So what they've done is they've kicked out or they've declined or removed or whatever it is starting August 1st. So about 8 days, this extra 0.5%. So I would not call it a discount. I think it's inaccurate. It's just removing an extra 0.5 point that was there. Yeah. I think it's a good sign. I think it makes it easier for people to refi if you want to, rate and term or cash out. Rate and term, yeah, whatever. Or cash out. Yeah, I think it's generally a good sign. Matt, Michael, are you marketing beyond your buy box and daily rituals for analyzing the market, such as mailers, dying for dollars, etc.? So Matt, I do two things. One is I practice what I preach. So I have a buy box where I have alerts set up. That's all MLS based. But thankfully, I also have a large network, which I talk about in my course, that brings me deals all the time. I am not doing any direct marketing. I don't market anything, folks. I don't market my book or course, or I just do what I do. So no mailers. I don't live in the city I invest in, Matt. So I don't do driving for dollars. You would be surprised at how lazy I am. I have a daily discipline and I've been executing it for 20 years. And I value my network beyond all else. And people bring me deals. The only deals I got last year were from my network because it was such a seller's market. Oops, John, where are you? There you are. Once you establish a price range that works in your spreadsheet to get your yield, is it necessary to enter new properties every week in the spreadsheet, or can you all buy? John, that really, so, I mean, frankly, I eyeball everything. I haven't added properties to my spreadsheet in a long time unless I want to follow up. So I would tell you the routine, the daily exercise of updating your spreadsheet, John, probably after 100 days, you can slow down. But one thing I still do is I add properties that I want to follow up on. My memory is not as great as it used to be. And my family would tell you it was never great to begin with. So shout out them for constantly reminding me of that. But any property I want to follow up on that I really like, I will put down and track and follow up every 2 weeks. Hopefully people are hearing me when I say that, because how I was getting deals when Wall Street changed the game, right? I've lived through Wall Street buying houses before, folks. Wall Street came in and started buying entire books of properties. The only way I got deals once they showed up was follow up. What you don't realize is Wall Street locks up a lot of properties, but doesn't close. So if I like a deal, I will write it down and I will follow up every 2 weeks until it either closes or hopefully I get it before. Because what I want to do with follow up is I want to get it before it goes back on the market. That's the key. Hopefully that answers your questions, John. At least kind of hopefully answers. Yeah. Weimar Republic. Yeah, that I don't know about you, Jeffrey, but that scares me a lot more than a crash. Yeah, Josh. Yeah, the hyperinflation is I mean, like hyperinflation, like 25% is frightening to think about. Even as landlords, and I meant it. I don't know if people caught it. I would have to change my leases to month. If if hyperinflation is that bad, a year lease would be bad. It would. It's really frightening to think about as I sit here and think about it. So yeah, high inflation would be it'd be bad. Yeah, no eyeballing. Do the work every day. Yeah, unless you've been doing it 20 years, then you can do what you like. Tamika, wonderful answer. I like that. I also fell if we have long-term debt cash. Yep, I agree, Josh. Yep. Hi, Amber. I'm 62 and have only was taught if you can't pay for it with cash, can't afford it, and have lived that rule of thumb all my life. Awesome. Yeah, I love I think there's a song out there by Jay-Z that says if you can't buy it cash twice, you can't afford it. I think that's wonderful advice. I think it's wonderful advice. Oh, the Great Depression books. I've not read either of those. Oh, when do you expect mortgage rates to rise? God, that's a great question. Not until next year. It's probably at least a year away. I don't know how. Yeah. And again, what do you mean by rise, right? Can they go up a tenth of a point? Sure. I suspect by December 31st of 2022. So what would that be? Let's call it 18 months. 30-year rates could be at 3.5 or 4. So I would call that a rise. I own it all, not in debt. You can always count on death and taxes. Yep, sure. That's a great saying. Is it a good strategy for me to take a 401k loan to pay for my investment property down payment? If stock market crash, I win, diversify. Again, I don't give financial advice because I don't know the complete story. I don't know your plan. I don't know your impact if you change jobs. There's so much in that. All I can tell you is if you read my book, you know that I took 401k loans during the crash, 2010. I took a 401k loan. But yeah, I don't know your situation. All I can tell you is what I did. And in my situation, I took a 401k loan because it allowed me to buy 3, 4, 5 properties in a 3 or 4 year period. So, yeah. I only use month-to-month rental agreements anyways. Who does a long-term lease to protect? Okay, sounds good. If they want out, they are out, and we need to turn the rental and move on. I have many long-term tenants. Okay. Okay, cool. Awesome. All right. So another thing I want to talk about, again, keep the questions coming. I will answer one at a time. The next thing I want to talk about is recycling capital. This is something I did not appreciate until I wrote my book. It wasn't something I consciously thought about, but it happened. And it was a huge part of our journey. So if I were to summarize the phases of our book, right, we come into real estate investing with 40 grand. That's all we had. That 40,000 bucks basically got us 3 houses. Then we were out, 40 grand gone. Psh, gone. But what happened is I happened to be investing in a market that went up a lot. And by the time we bought the 3rd house, I think it was about 2.5 years since we bought the 1st house. If you read my book, you know what happens next. The first thing I did is I recycled capital. I went back to the 1st house and took out too much money. I created my alligator, which was painful and is the only picture in my book. So don't do that. But I did that. And what we did with that, I don't remember what it was. I'm going to guess it's 40 grand. So the 20 we put in and then 20 more. We bought 2 more houses over a year. And again, time went by and we did a cash out refi in the 2nd house we bought. And we bought 2 more. And then we did cash out refi in the 3rd. So that first 40 grand for us over the course of 5 years got used twice. And actually, that 40 grand, I guess when we look at the whole portfolio, we didn't have any money in our first 8 deals, right? Because we put 20 in, we took 40 out. We put 10 in, we took 25 out. We put 10 in, we took 22 out, something like that. Then what happens? If you read our book, you realize prices go up. I can't buy anymore. So we do what's called a 1031 exchange. We take equity, which turned out to be fake, but good for us. And we moved all of that into houses. So we went from 8 to 80 with none of our own money. Now that sounds fun, but you got to realize that's now over a span of 6 or 7, maybe 8 years. And again, this was never a conscious thought. I never went into this going, oh, I'm going to use that dollar 5 times. But if you're in the real estate game, I want you to realize that as time goes by, you are going to have the option to recycle capital. Be wise, just like the home equity line I talked about earlier, except I will take out more debt on investment properties. But watch it. Every asset needs to stand on its own. I'm still upset and mad at myself that I turned my first asset into an alligator. Hence, I wrote about it and I talked about it. Don't do that. But yeah, recycling capital is something not enough experienced real estate investors talk about. It was a huge part of our portfolio. I intend to buy everything and hold everything forever, but that doesn't mean I'll keep the same debt forever. There's a difference. Like I talked about earlier, respect debt, but don't fear debt. Right now we owe millions and millions of dollars in debt, and we're financially free. So again, respect it, structure it. No short-term debt. Short-term debt will blow up, just like Dave Ramsey likes to talk about. It will. So yeah, that's experience. So back to your questions. Silver, gold in hand, not paper. Done this forever. That's real money in my opinion. Okay, cool. Yep. Do you own property in Canada? Nope. I don't own property anywhere except California, which drives some people crazy. You invest in Fresno, which is much lower cost of living compared to where you live. That's true. What strategies would you use to invest in high cost? Where are you? High cost living areas such as where you live. Well, JC, if you read my story or read my book, you know that I tried to I spent a year, yes, 52 Sundays. It still drives me crazy that I was that focused. Looking for a deal in the Bay Area. My requirement was cash flow, and it doesn't work. So if you're going to invest in the Bay Area, you got to bet on appreciation, which is not something I will ever do. So I have no good answer. I'm not your guy. I have no experience in investing in high priced areas, and I don't talk about what I don't do. So unfortunately, I live where I want, and I invest where the numbers make sense. They don't make sense in the Bay Area. So not your guy. I'm sorry. I learned to hate alligators after reading your book. Awesome. Rather than buy a pig with fleas, since I can always kill the fleas and have a happy pig. There you go. Value add. Oh, that's a good analogy. I like that. I might steal that someday. That was very creative. I had not heard that put that way before. Would you do a cash out refinance on your property, primary residence that is paid off to invest in real estate with rates so low? Again, I don't know your situation. I don't know your age. I don't know. There's so much in that. I think people giving financial advice when they don't know, it's like a doctor that knows nothing about you. I will say that owning your primary residence free and clear is a wonderful goal and something I strived. What's the past tense of that word? Whatever the past tense. To get there, it's an awesome feeling. However, if that was my goal when starting out, I'd still be working, if that makes sense. There's no way I could have grown our real estate portfolio of rentals if my goal was paying off my home. However, I'm on the other end of that, and having a free and clear house is awesome. So I don't know where you are in that situation. So Michael, are you not paying off debt? You are using cash to buy more debt. Well, again, I've been doing this a long time. I have a portfolio of some free and clear and some with debt. I lived through the last crisis and saw what happened to people that had debt, and a lot of them lost it. So I own plenty of assets. Um, my LTV is much lower than most people would think. So I'm far more conservative than most people would think. Balloons are for kids and clowns. Okay, sure. I invest in LA, high priced, and it took 5 years to break even. Up on equity though. Yeah, that's not for me. That's not for me, but congratulations. Yeah, but not for me. The thing with this bubble is that there's $1 trillion of cash lying in banks right now, reverse repos waiting to jump on a. Yeah, dude, the freaking reverse repo, $1 trillion. And near as I can tell, smart money, call that what you will, is comfortable sitting in cash, which is a signal or a sign. Yeah, that's a sign. That's a sign. That's definitely a sign. Yes, I agree. It's hard to pay off my house when it's at 2. Yeah, no kidding, right? But again, I don't know where you are in life situation, all of that. All I got to tell you is go get that 30-year money, 30-year fixed. I did a cash out refi 5.25, and then 2 years later did a rate and term at 2.5. The cash out was effectively refi at 2.5. Yeah, I've done those. Absolutely. Yes, the buy box is step 1 of my course. Absolutely. Yeah. Yes, and I do have a free course. Yep, free course. The ever popular now thousands of students how to get started one rental at a time. So glad I created that. It's helping so many people. Oh, let's talk about multifamily while you guys put in more questions. I don't know if you caught the interview with Jonathan Twomley yesterday, interview number 3, I think it was. We talked about small balance multifamily. Now, this is going to sound funny, but a small balance multifamily with Fannie and Freddie is $7 million. $7 million and below. Fannie and Freddie just changed the picture. And it's interesting to talk about what it is, reserve requirements, net worth, all of that. I don't really care. What I care about and what I look at is, oh my God, Fannie and Freddie is so nervous about their loan book. They want to reduce new loans. Think about that for a minute. Fannie and Freddie, small balance loans under $7 million, their loan book has to be getting shaky. And oh, by the way, what have I been telling you for 6 or 9 months, maybe even a year? I've been telling you that people have been overpaying for small multifamilies. I do what I say, and I sold 3 apartment buildings because I believe people were overpaying. Now we have Fannie and Freddie validating that their loan book is less good. The thing that I've learned about multifamily is the owners can limp along for a long time. As I talk about in my book, we ultimately bought apartment buildings last cycle for 0 down, but it was years after single families bottomed. So I expect multifamilies, the 5s to 20s, the 5s to 40s, to show a lot of pain in 2 or 3 years. I am very interested in that. So yeah, I'm going to be buying homes and hopefully 1031ing into multifamily. So yeah. All right, let's go back here. What do we got? In your videos, you mentioned that you don't calculate anything apart from cash flow. Okay, yeah. I don't calculate it. I don't worry about it. I don't think about appreciation, equity buildup, discounts. It's all fake to me. I only want to know how hard my cash is working. Everything else is fake. If I wanted to make my net worth look bigger, I just change what I think my houses are worth. It's just such a bogus number. I've invested in cycles where properties are falling 5% a month. I've invested in cycles where they're going up. It doesn't matter. The only thing that matters at the end of the day is the cash flow, or what I call yield. All that other stuff is not important. You can calculate it, but it's not interesting to me. Oh, why did I change my hair color? Well, the story there is my wife went and got her hair dyed I don't know. What was it? 2 months ago, maybe 6 weeks ago. And if you've been following my channel, one of the things I promised to do months ago is if we get to 500, I was going to dye my hair purple, something crazy, right? Fun. If you do 500, I'll dye my hair purple. So I just wanted to see what getting your hair dyed was all about. So I sat in the chair for 3 hours and got my hair dyed. It was weird, but I don't know. That's why I did it. Wanted to sit next to my wife. We talked for 3 hours. It was cool. And now I'm ready to get my hair dyed purple if you guys get 500 deals. I've noticed you are doing more flips. What is your minimum net yield to purchase, fix, and flip? I'm actually doing less flips. I've now done about 60 flips. I think I did 45 or 50 in 2 years, 18 and 19. Didn't do many last year, not doing many this year. But to answer your question, I wouldn't touch a flip unless I saw 25 grand. It's just not worth it. Chris, does Fannie and Freddie concerns in their loan book include refinances, or is that new purchases? I don't know. That data was brought to me by Jonathan, who's a multifamily syndicator. I'm going to guess based on the conversation we had about it. And again, it's recorded. I think it posted yesterday at 2. I think it was purchases. It was purchases, but I don't know that for sure. Wow, he now does $30 million deals. That's awesome. Good for him. What else do I have here? Yeah, I think I got everything. That's what I wanted to do for this impromptu conversation. Again, it's the weekend. If you've thought about real estate investing, I think this is the market to get started. You got to do the work. Buy the course below. It's $300. Got everything I did, plus all the bonus sections. You need a buy box. You need to focus. You want to talk flipping. It's in there. You want to do wholesaling, self-management. It's all in there. This was fun. Totally impromptu. No idea if I will do this again. But you can count on tomorrow, Saturday, 8 a.m. I will do it again. We'll see how it goes. Have a wonderful day, everyone. Take care. Bye.